All right, stop scrolling for a second because something just snapped in silver, and it happened fast. I'm talking about roughly 37% gone in days, with Western prices collapsing from about $121 to the mid-80s while Shanghai barely blinked, still trading near 122. That spread alone is screaming at you. Both the futures tape and the physical market just confirmed the same thing at the same time. This wasn't a demand collapse. It was mechanical. It was forced. And what you do as this week opens actually matters. Stay with me because I'm going to show you what just happened, why it keeps happening in silver, and how you can recognize this pattern the next time before the headlines catch up. If you're holding silver right now, watching from the sidelines, or trying to understand why your portfolio just took a hit, you're exactly where you need to be. Your job isn't to panic. Your job is to understand what's really happening here. Before I explain what caused this, let me teach you something most people miss. Silver doesn't behave like stocks. It doesn't even behave like gold. Silver is thin, leveraged, and emotional, which means when it runs too far, and when it breaks hard. Think of it like a crowded elevator with borrowed money. As long as it's going up, everyone's fine, everyone's happy. But when it drops even one floor too fast, people don't calmly step out. They're forced out. That's the key word. Forced. Most people look for new supply or collapsing demand when they try to figure out why a market crashed. You should be looking for leverage, margin, and positioning. That's how you get ahead of these moves instead of reacting after the damage is done. Here's what I mean by that. When you see a market move this violently, this quickly, without any corresponding news event, you're not looking at fundamentals changing. You're looking at structure breaking. And structure in silver means one thing above all else: leverage. See, silver trades on thin liquidity compared to its volatility. It's a small market. When institutional money shows up with borrowed capital chasing momentum, the whole thing can move 10, 15, 20% in days. That works beautifully on the way up. Everyone makes money. Everyone feels smart. But leverage is a two-way street, and the road down is a lot steeper than the road up. So what does that tell us? It tells us that you need to watch different signals than you'd watch in equities or bonds. In silver, you need to watch margin requirements. You need to watch open interest in futures. You need to watch premiums between physical and paper. You need to watch volatility spikes, because those are the early warning systems. Those tell you when the elevator is about to drop. And if you understand those signals, you can position yourself accordingly. You can step aside before the chaos, or you can prepare to step in after the liquidation exhausts itself. Either way, you're making informed decisions instead of emotional reactions. Now here's what's actually happening. Let me break down the sequence in plain language, step by step, so you can see exactly how this unfolded. Silver went parabolic, fast, too fast. As prices surged toward $120, paper positioning exploded. Futures, options, leveraged ETFs, all of it piled in. Traders were layering on leverage, chasing the move higher, and the market kept rewarding them. That works until volatility spikes. And volatility always spikes eventually. It's just a question of when. When volatility spikes, margin requirements jump. Now, if you're not familiar with how margin works, here's the simplified version. When you trade futures or leverage positions, you don't put up the full value of what you're controlling. You put up a fraction. That fraction is called margin. But that margin requirement isn't fixed. It adjusts based on how volatile the market is. When things get choppy, the exchange says, hey, this is riskier now. You need to post more cash to hold that same position. When margin jumps, someone has to post cash. And here's where it gets interesting. A lot of traders and funds don't have unlimited cash sitting around. They're already leveraged. They're already deployed. So when the margin call comes, they have a choice. Post more cash or close the position. And when they can't post the cash, they sell. Immediately. They don't wait for a better price. They don't wait for the market to stabilize. They sell whatever they can right now, because if they don't, the exchange will do it for them. So when that first downtick hit, it wasn't one seller making a rational decision. It was a cascade. Forced selling begets more forced selling. Prices gap lower, stops trigger, algorithms kick in, liquidity vanishes, and suddenly you're down 20-30% with no news attached. No headline saying demand collapsed. No announcement that supply surged. Just pure mechanical liquidation. And that's exactly what we saw. Here's what's wild about this. While Western paper markets were imploding, physical silver in Shanghai barely moved. Premiums blew out to over 40%. Let me say that again. 40%. That means physical buyers in China were willing to pay 40% more than the paper price in New York. That divergence is the confirmation. Paper was liquidating. Physical wasn't rejecting silver at all. If this were a true demand collapse, you'd see physical prices falling in lockstep. You'd see premiums compressing, not expanding. But that's not what happened. The physical market stayed firm. It's the leveraged paper market that broke. And here's the part that should make you nervous and focused at the same time. We're now in price discovery. That means the market is trying to figure out where forced selling ends and where real buyers step in. That process isn't polite, and it doesn't care about your entry price. It doesn't care what you paid. It doesn't care what you think silver should be worth. It only cares about where the next willing buyer meets the next willing seller. And right now, we're still figuring that out. Now let me show you what very few people are talking about. This pattern, this exact sequence, has played out before in silver, multiple times. And if you zoom out and look at the history, you see it clearly. In 2008, silver crashed over 50% in months. Over 50%. Not because people stopped needing silver, not because some new massive supply source came online, but because leverage unwound. The financial crisis hit, margin calls went out across every asset class, and silver got liquidated along with everything else. The move was brutal, fast, and indiscriminate. Sound familiar? In 2011, after the blow-off top near $50, the drop was violent, fast, and confidence-shattering. Silver went from $50 down to the low 30s in a matter of weeks. Then it chopped around with brutal volatility for months. Traders who bought the initial dip got crushed. Traders who thought they were catching the bottom got stopped out. It took years for silver to rebuild any kind of stable uptrend after that. And the whole time, the fundamentals of silver demand didn't change that much. What changed was sentiment, leverage, and positioning. And in March 2020, during the COVID crash, silver collapsed in days as funds sold everything that wasn't nailed down. Remember that? Stocks crashed, bonds crashed, gold crashed, silver crashed. Everything liquid got sold because funds needed to raise cash immediately. Then, once liquidation ended, silver ripped higher. It went from the low teens to almost $30 in less than a year. But that initial crash, that was pure forced selling, pure panic, pure mechanical liquidation. Every time this happens, the sequence rhymes. Parabolic run, margin shock, forced selling. Then either a volatile rebound or a deeper retest, depending on whether the liquidation is complete. The larger story here is that silver doesn't ease lower in a nice, orderly fashion. It resets violently. It breaks structure. It shakes out weak hands. And then it either recovers or it retests lower lows. But it doesn't politely decline 5% over 3 months. That's not how silver works. If you've seen this pattern before, you know exactly why this week matters so much. Because we're in that critical window where the market decides what comes next. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this keep falling? Absolutely. Could we see $70 to $75 get tagged if liquidation resumes? Yes. Is that likely? I don't know. But it's possible. And if that happens, suddenly even the conspiracy theories about $50 downside don't sound crazy anymore. Could we see another leg down if volatility stays elevated and more margin calls go out? Sure. That's how cascades work. They don't always stop at the first support level. Could this be manipulation? Look, I've heard all the theories. Market makers suppressing prices, big banks controlling the tape, central banks intervening, maybe. Maybe there's truth to some of that. I'm not going to sit here and tell you markets are perfectly efficient and fair, because they're not. But here's the thing. It doesn't actually matter whether there's a shadowy hand pushing prices around. The mechanics are what matter. Leverage is what matters. Positioning is what matters. Volatility is what matters. You can spend all day debating whether JP Morgan is evil or whether the Fed manipulates metals, and you still won't have an actionable edge. Focus on what you can see. Focus on what you can measure. Focus on signals you can actually use. The mistake too many people make is obsessing over motivation instead of watching price action and structure. Does the spread between Shanghai and New York matter? Yes. Does open interest matter? Yes. Does volatility matter? Yes. Those are things you can track. Those are things that give you information. Conspiracy theories don't give you an edge. They give you an excuse. And if you're trying to navigate markets, you need information, not excuses. So here's what I'd say. Be skeptical. Question everything. But don't let skepticism turn into paralysis. Don't let it turn into a narrative that prevents you from seeing what's actually happening. Watch the data, watch the signals, and make decisions based on structure, not on what you wish were true. There are probably 3 types of people watching this right now. Let me speak to each of you directly because I think you're all in different positions emotionally and practically. Maybe you're overexposed, maybe you bought silver on the way up, feeling confident, feeling like you finally caught a big move, and now you're staring at your screen, wondering if you just ruined your year. If that's you, slow down, take a breath. You don't need to make a heroic move based on emotion right now. What you need is stabilization. You need to see prices hold the $80 to $85 zone. You need to see volatility start to cool off. You need to see Shanghai stay firm above 115. If those things happen, you've got a case that the worst of the forced selling is behind us. If they don't happen, if we break lower on rising volume, then you might need to reassess your risk. But either way, don't make decisions from a place of panic. Give the market time to show its hand. Maybe you're on the sidelines. Maybe you watched silver run and you thought you missed it. Now you're watching it crash and you're thinking, this is my chance, I'm going to catch the bottom and ride it back up. If that's you, patience is your edge. Let the market show you exhaustion before you act. Don't try to catch a falling knife just because it's falling. Wait for signs that forced selling is done. Wait for a base to form. Wait for volume to dry up on the downside. Wait for a rally that holds. You don't get extra points for buying at the absolute bottom. You get points for buying when the risk-reward makes sense. And right now, we're still in the liquidation phase. Let it play out. And maybe you're long-term bullish and unfazed. Maybe you're stacking physical. Maybe you view this as noise. Maybe you've been through these crashes before, and you know they don't change the fundamental case for silver. That's valid too. I respect that perspective. But even if you're in that camp, you should respect liquidity events. You should respect the fact that crashes create better timing opportunities. If you're buying physical anyway, wouldn't you rather buy at 80 than at 120? If you believe in the long-term thesis, liquidity events give you better entry points, so don't ignore what's happening just because you're confident in the decade-long picture. Use it. No matter which bucket you're in, the universal principle is the same. React to structure, not headlines. React to what the market is actually doing, not what you think it should do or what some talking head on TV says it should do. Watch the data. Watch the spreads. Watch the volume. Watch whether buyers step in or sellers stay in control. That's how you navigate this. Not by guessing, not by hoping, by watching and responding to what actually unfolds. So here's where I stand. I'm not panicking and I'm not pounding the table either. I'm watching three things very closely. First, I'm watching whether silver can hold the $80 to $85 zone as forced selling fades. If it can, if we see buyers step in there and defend that level, that tells me liquidation is exhausting itself. That tells me we might be near a short-term bottom. If we break below 80 on heavy volume, that tells me there's another leg down coming, and I need to wait longer. Second, I'm watching for a deeper washout towards $70 to $75. If that happens, it would signal that liquidation isn't done. It would mean there's still more leverage that needs to unwind. And honestly, if we get there, that might actually be the better long-term opportunity because it would represent true panic, true capitulation. Sometimes the best setups come from the worst drawdowns. Third, and this is the most important one to me, I'm watching whether Shanghai stays elevated above $115. That's the confirmation that physical demand hasn't cracked. That's the signal that this is paper liquidation, not fundamental rejection. As long as physical markets stay firm, as long as premiums stay wide, I know this is structural, not fundamental. And structural breaks are temporary. Fundamental breaks take years to repair. So that divergence between paper and physical is the key tell for me. Based on my analysis, this crash was mechanical, not fundamental. It was leverage unwinding, not silver being unwanted. The physical market didn't reject silver. The paper market liquidated positions. Those are two very different things. The fundamental picture for silver, the long-term supply-demand dynamics, the industrial use case, the monetary demand, none of that changed this week. What changed was positioning. What changed was leverage. What changed was sentiment. And those things are temporary. Those things reset. Those things create opportunity. If history rhymes, and I think it will, the next phase is volatile, emotional, and full of opportunity for people who stay calm. We might see a sharp bounce. We might see more downside first. We might see choppy consolidation for weeks. I don't know the exact path, but I know the pattern. And the pattern says that after forced liquidation exhausts itself, silver doesn't just sit there quietly. It moves, and it moves fast. So if you're positioned appropriately, if you're watching the right signals, if you're not over-leveraged and not emotional, there's going to be a window to act. Just make sure you're ready when it comes. Now, I'm not a financial advisor. This is not financial advice. I'm sharing my analysis, my perspective, my framework for watching this market. But you need to do your own research. You need to make your own decisions. You need to understand your own risk tolerance and your own time horizon. Don't take what I'm saying and blindly act on it. Take what I'm saying and use it as a framework to do your own thinking. If you made it this far, you're in the top few percent of people actually trying to understand what's happening instead of just reacting. That mentality, that commitment to learning the patterns, to watching the data, to thinking critically instead of emotionally, that's what separates people who survive these markets from people who get wiped out. Keep that mentality. Keep asking questions. Keep verifying. Keep thinking independently. That's your edge. If this breakdown helped you see silver differently, do me a favor. Share this with someone who needs to see it. Hit that subscribe button so you don't miss the next pattern I'm tracking. And drop a comment below telling me what you're watching in silver right now. Are you seeing the same signals I'm seeing? Are you positioned? Are you waiting? I want to hear from you, because we're all navigating this together. And the more perspectives we share, the better we all get at reading these markets. Stay sharp out there, think critically, verify your data, and make your own decisions. I'll see you in the next one.